Good day, everyone. I'm Shira Zimmerman, Investor Relations Manager for the Trendlines Group. With me today are Steve Rhodes and Todd Dollinger, Chairs and Chief Executive Officers of the Trendlines Group, and Chaim Brosh, our CFO. The aim of the meeting today is to give a very brief overview of who we are for any newcomers and a business update of the last few months. We've already received several questions, so we'll keep the overview short to allow time to address them all. To submit a question, you can use the question and answer function in the conference call, or alternatively send them to 972-50-8777-013 via WhatsApp, plus 972-50-8777-013 via WhatsApp. The presentation, as well as a recording of today's event, will be available on the investor page of the Trendlines website. So if you have to leave for any reason, you'll be able to catch up later. Please note that this presentation may contain comments that constitute forward-looking statements which involve risks and uncertainties. Examples of forward-looking statements include descriptions regarding the intent, belief, or current expectations of the company or its officers with respect to future results of business operations and financial condition, industry, environment, and future events and plans of the company. Such forward-looking statements are not guarantees of future results, performance, or achievements. Actual results, performance, or achievements of the company may differ from those expressed in the forward-looking statements as a result of various factors, such as known and unknown risks and uncertainties and assumptions, including those risk factors discussed in the Trendlines offer document dated 16 November 2015, and in the company's filings on the SGXnet, which you are encouraged to review. By their nature, forward-looking statements involve risks and uncertainties because they relate to events and depend on circumstances that may or may not occur in the future. In light of these risks and uncertainties, actual events, results, and developments could differ materially from those expressed or implied by the forward-looking statements. The statements represent the company's or its officers' views only as of the date they are made and should not be relied upon as representing the company's or its officers' views as of any subsequent date. The company does not assume any obligation to update any forward-looking statements. Finally, please note, all monetary values cited are in US dollars unless otherwise specified. I'll now turn the presentation over to Todd Dollinger, Chair and CEO of the Trendlines Group.
Thank you, Shira. It's my pleasure to be here with you this afternoon. It's afternoon for me because I'm in Singapore, excuse me, at the offices of Trendlines Medical Singapore. I'm privileged to be here thanks to the courtesy of the Singapore government that's allowed me to travel into Singapore and spend time with our staff in spite of the restrictions that are generally placed on visitors in Singapore. I'm sorry that I'm not able to visit with more of you in Singapore. As I say, I'm under severe restrictions, largely to be at our office and substantially quarantined to eat by myself each of the meals during the course of this visit. But I very much appreciate that our friends at Enterprise Singapore have arranged for this along with our staff and allowed me to make this visit, which has been very interesting after 2 years away from Singapore. I'm just going to give you a brief review of what we can call Trendlines by the numbers. I think, as everyone knows, we have 3 locations at Trendlines in Israel, Singapore, and China. Our China staff are business development focused for our Trendlines Innovation Labs activities, as well as in support of our portfolio companies. We actually have 2 locations in China, in the Putuo district of Shanghai, and our partnership with Chongzhou government in Chongzhou and Jiangsu province, where we support the activities of our Trendlines Innovation Labs team. We've been at this for some 14 years now. Steve and I have actually been working together for over 30 years and 14 years as the Trendlines Group, the investment company that you know for our work in health and in food, all for the purpose of investing to improve the human condition. Today, we have 62 companies in our portfolio, And 20 of those companies, very importantly, 20 of those companies are advanced stage companies, companies that have really started to prove themselves in the world, and companies that we look forward to doing great things in the near term. Just recently, we had our 10th exit. That was the sale of our company, OrthoSpin, to Johnson & Johnson. It was an excellent return for us, and we'll talk about that more a little later in today's presentation. Overall, our exits have been at an on weighted average at 9.7 times the money that we've put in, and an IRR on those exits of 175%, something that we're, of course, quite pleased with. And our stock has done well in the course of this last year. We take a look at the date of up to the 8th of November, and we see almost a 30% increase in the value of our stock. We have more room to go there. We regard ourselves as having great opportunity in the stock, but a near 30% increase, something to be proud of. And as well, our equity as of the middle of this year, as of the end of June, has reached over 100 million US dollars. Another point that pleases us. I think if we think about how we invest at Trendlines, there are really three things we tend to focus on. We are very, very market focused. We're often misunderstood as being technology focused, and it's true that innovation is at the core of what we do, but our focus is markets first of all, and then people. You can't really rank what's more important, markets for the people that work and lead Trendlines and lead our portfolio companies. It's markets and people, and technology comes in third. But it's the people on this slide, the leadership, the senior leadership of the Trendlines group that really make things happen. We're so proud, Steve and myself, to be associated with these people, with Chaim Brosh, who our CFO, who has joined us today for this presentation, has been with us for many years now. Starting out as our controller and moving up to CFO and taking us through many transactions, advising our portfolio companies, and of course, our board of directors and Steve and myself. Just a great asset for the Trendlines group. Nir Goldenberg, also someone who was promoted. He started out in business development at Trendlines Labs, and now is the CEO of Trendlines Innovation Labs. And he'll bring this activity to a record this year. Barak Singer, CEO of Trendlines Investments Israel, responsible for our medical and food investments in Israel, a very important part of our leadership team. And Eric Lowe, who I'm visiting with here in Singapore, who heads up Trendlines Medical Singapore, where today we have 13 portfolio companies, and we're seeing really great moves in these portfolio companies. Next year will be a very important year for Trendlines Medical Singapore. We look for great things. And of course, Nitsa Kardish, Dr. Kardish, who heads up our agri-food operations, responsible for our agri-food operations in Singapore, and also for sharing responsibility for many of our agri-food investments in Israel with Barak. Another great asset to the company. These are the people that choose the markets that we're in. These are the people that really continue to advance us as a company. It's with them, as we move on, that we see that it's partnerships that are really at the heart of Trendlines. Our own staff make up a principal part of that partnerships, and partnerships are at the very core of all that we do at Trendlines. We talk often about our partners who are our investors, our entrepreneurs, and our strategic partners. And today, we want to highlight a few of our most important strategic partners. Bayer Group, which is a major player in both food and in pharma today, with whom we have a venture fund where we act as the general partner and they're the limited partner, which has so far made 3 investments with us, and there are more ahead. A great, important partnership for us today, one of the most important companies worldwide throughout the agri-food industry. B. Brown, who was the cornerstone investor when we IPO'd, has acquired a company from us, has invested in additional portfolio companies with us, and also participated very profitably in the exit from OrthoSpin a few weeks back. And finally, and perhaps most importantly, is our partnership with Consensus Business Group, a group controlled by Vincent Cengiz, the British billionaire who has been investing extensively in the life sciences in Israel, America, and elsewhere. Consensus is one of the key investors in the Trendlines Agri-Food Fund, has invested in more than 20 of our portfolio companies directly, and today holds 23% of the Trendlines Group, a truly important and valued partnership and a friend with whom we consult regularly, and we greatly appreciate his work with us, with our companies, and with our funds. With that, I'm going to turn things over to Steve Rhodes, who shares the chairmanship and the CEO position of the Trendlines Group with me, to tell us more about our portfolio companies and our activities. Steve?
Todd, thanks for that overview. As Todd mentioned, today we have some 62 companies in our portfolio, which is a record. And people often say, with 62 companies in the portfolio, how can I possibly understand what the value of Trendlines is and what's going on? What we'd like to do today is just give you a taste of some of our most interesting and most mature companies. Todd mentioned that we have some 20 companies that are in an advanced stage. This is an important point that we'll be coming back to over and over again as we go through this overview, because we're in a different place than we were 5 or 6 years ago. Today, we have a portfolio that has many more mature companies. We had a large exit in 2020 with Epifix. We had another large exit in 2021 with OrthoSpin. And as Todd said, we have some 20 advanced companies that we think could be candidates in the future, in the not distant future, for exciting developments as well. So what I'd like to do is briefly show you some of our more advanced companies and give you a sense of the great value that's being created here. Fidalon is a company that has developed a completely natural food colors produced through an industrial process instead of having to use agriculture. The company raised $4.7 million last year and has entered into numerous pilots with multinational food companies, some of the biggest names in the industry. The response to the company's product has been phenomenal, and the company is making great progress. We expect them to come to market in the next year or two with product and to be very, very competitive in the world scene, given the exciting responses we've been receiving from partners around the world. Taking a look at some of our other agri-food portfolio companies, just briefly, FruitSpec recently completed a $5 million investment round. AgriScout announced earlier this year that they had completed a $7.5 million round. Viaqua announced that they completed a $4.3 million round. These are all investment rounds that are larger than we've had in the past. And again, they're indicative of the increasing maturity of our portfolio. Our goal, our alternative protein company producing protein from grasshoppers, is going into sales, has been shipping product in China, the United States, and elsewhere, and signing contracts for strategic partnerships and distribution agreements. FruitSpec is selling in the US, in Latin America, and in South Africa. AgriScout will hit about $500,000 of sales this year, has signed important strategic agreements with major producers in Latin America, and is growing very rapidly. And Viaqua is producing vaccines, orally administered vaccines for shrimp and other marine animals, has important strategic relationships with Nutraco and Spreading, and in the investment that it closed this year, brought in for the first time a major US VC as well. So we've seen great progress on in the agri-food portfolio, and similarly in the medical device portfolio, we're seeing great things happen. Vensica is a medical device. Actually, it's a company that started out as a device company and has transitioned to become a drug device combination company. The company had two very exciting announcements this summer. Earlier this year, we announced a strategic partnership with Merz. Merz is a large German pharmaceutical company that has licensed their generic Botox product to Vensica for exclusive use in the urology field. And just a month or so ago, we announced that in in light of that strategic announcement, Vensica completed a raise of $16 million. It was led by an Israeli VC and was joined by the European device company Laborie. So we expect great things. And of course, a $16 million round highlights the tremendous value of the company and the advanced stage that it's in. Other medical device companies that are doing great are shown here. And these are just 4 out of our 35 healthcare companies. It's particularly exciting to note that 3 of the 4 companies listed here, Arcuro, ST Stent, and FeedMe, all have FDA clearance and are all selling in the United States. All are in early sales, but we expect them to develop great traction as they sell and build and attract interest. Liberty, the only company that doesn't have FDA clearance here, actually is expecting to receive it in the coming months. They've applied for it and will begin selling, we hope, in 2022. Liberty is for home dialysis. Arcuro is sports medicine. ST Stent is for sinus surgery, and FeedMe is a gastroenterological product for enteral feeding. These are great companies, and like these companies, we have 31 more. So we're really looking at exciting things happening in the portfolio. The portfolio has grown greatly since we began operations 14 years ago, including cumulative exit proceeds. It's consistently increased, reaching $129 million at the end of June. And if we include the OrthoSpin exit, actually reaching about $140 million as of today. It's important to note that this is not including the value of 13 companies in Singapore, which are consolidated and so aren't reported at fair value. At the end of the first half of 2021, the fair value of our portfolio was $92.1 million, compared to $83.7 million at the end of 2020, a 10% increase in value over 6 months. Since our IPO, our portfolio value has more than doubled, not including the estimated value of future earnouts from several of our exits. Our portfolio is stronger and more mature than ever before, and we expect continued growth and strong performance ahead. And one of the things we think indicates the maturity of the portfolio is the amount of follow-on capital that the companies have raised. On the right-hand side, you see a graph showing the amount of follow-on capital raised by our portfolio companies year by year. The amount of capital raised has actually doubled since 2015 to 2020. In 2020, we raised some $43 million for our portfolio companies. To date, we've already raised over $50 million this year for portfolio companies. This is a portfolio that's maturing, that's getting close to exciting things, as reflected by the EpiFix exit and the OrthoSpin exit. We're very, very optimistic and excited about the future. And speaking of the future, I'll hand things over to our CFO, Chaim Brosh.
Thank you very much, Steve. In the following slide, we are presenting the value of our exits in comparison to the book value of the exited portfolio companies just before the exit. You can see that the exit value is more than 4 times the book value. Need to note that the exit value does not take into consideration, as Steve just mentioned a minute ago, the earnout from the EpiFix exit and the potential royalties from the Stematics deals. So we do see that it is 4 times more than the book value. This is one representative of the hidden value we have in comparison to our NAV. And if we look on the next slide, thank you. We can see that in the last 3.5 years, while our cumulative exit proceeds went up and the fair value of our investment in portfolio companies consistently increased throughout those 3.5 years, as Steve just mentioned, the share price of the company remained relatively stable. This is not only to present this connection between the company achievements to the share price, but it is also show the opportunity to an increase in the share price to acknowledge those investments, those achievements. Need to note that the exit proceeds and the fair value in this slide does not take into consideration the OrthoSpin exit numbers and impact, while of course the increase the gap we will incorporate those data into this slide. Here we have a snapshot of a few of our key financial metrics. All of the metrics show an improvement over the first half of this year. Our portfolio value increased by 10% from 83.7 million to 92.1 million. Although the fair market value of the portfolio is reported on our books, our book value of $92.1 million, as we explained before, the exit value are much higher than the book value. And more than that, the fair value of the 92.1 million does not include the value of 13 of our portfolio companies, which are consolidated in our financials, another hidden value for our NAV. Our total equity increased by $4.2 million, and NAV per share increased to Singapore dollar 0.17 per share. Net profit for the first 6 months of the year was $4.5 million compared to a $4.1 million loss over the same period of last year, an $8.2 million swing. Todd will take over to tell a bit about the OrthoSpin exit.
Thank you, Chaim. The OrthoSpin exit, excuse me, the OrthoSpin exit is really a great representation of what we can achieve at Trendlines. This is a company that we have been deeply involved in since the beginning of the company, and we've gone through all of the challenges that are inherent to company creation, investing, company financing, and company growth. It's a long story that I won't tell you because today our focus in the discussion on OrthoSpin is really on the financial side. This was an exit of $79.5 million. We sold the company to the DePuy Synthes division of Johnson & Johnson. This was following investment by the Johnson & Johnson investment arm, Johnson & Johnson Development Corporation, JJDC. They made 2 investments with us in the company and worked with us to grow the company to a point where it could be acquired by Johnson & Johnson. I want to note that we owned 26.9% of the company at exit. That is our business model, to hold meaningful percentages of our companies. And we successfully did that here, although we only invested a total of about $1.3 million into the company. That exit matched up against the investment that we made, means that we had about a 12 times return on our cash and at an IRR of 165%. Clearly great numbers for a nearly $16 million exit. Now, I want to note that we own 26.9% of the company. And if you do the math on that against the $80 million exit, it doesn't seem to work. This is because we did indeed receive 26.9% of the net revenues from the exit. This was a tax disadvantaged deal in certain ways that caused extra expenses, but that is what the acquirer wanted. And we were able to negotiate key aspects, leaving us to be quite satisfied with the exit. OrthoSpin, in terms of our involvement in the company and in terms of the profitability of our exit, is a model for what we seek to achieve in our portfolio companies. I want to quickly give you just a note on some of the achievements that we've been through this year. And we have another 4 weeks to go, but we're very pleased by what's been achieved. Of course, we just talked about the OrthoSpin exit. Additionally, and very importantly, and I think Steve touched on this, is that we've had more larger exits, We've had more larger investments into our portfolio companies this year. As Steve spoke specifically about Vensica, which just raised $16 million. Additionally, AgroScout at $7.5 million, FruitSpec at $5 million. We're having larger investments into these companies. generally because these are maturing companies. These are key companies for us. These are companies we encourage you to keep an eye on as we work on these companies to help bring them forward in their development. On the regulatory side, our portfolio company Zygofix received CE mark and has done a number of surgeries in Europe. And important to note here is that our inventor behind Zygofix is the inventor behind EpiFix, the company that we sold last year for $79 million plus an earnout. We expect that earnout to be quite productive for us. It was $79 million in guaranteed payments, and the earnout, which will be added to it in the years ahead. Finally, I just want to take note of the clinical and field trials that we've entered into. Liberty, which is our dialysis company for at-home dialysis with parenteral dialysis, a really amazing company, is in trials now. Bessie Medical, which is dealing with non-invasive bladder cancer with cryosurgery, has been through its first trials. This is a company that has an enormous market as we move forward and continue the development. Zygofix, just to mention again, this is a miniature screwless implant for spinal fusion. This is the spinal issue that's the #1 reason for patients to have spine surgery. Metomotion, which is a robotic system for dealing with greenhouse vegetables. It deals with expensive, time-consuming tasks and fully automates it robotically. And finally, Phytolon, which Steve spoke about extensively, plant-based colors using baker's yeast as a biofactory. We're just thrilled with the portfolio. We'll continue on a selective basis to add to our portfolio. We'll continue to invest in our portfolio. And we will, with all of our staff, continue our dedication to supporting our portfolio companies. To wrap up the presentation for today, before we move to question and answer, Steve's going to talk about what's a really important event for us. We are really committed to ESG issues, to social issues, to governance issues, and we are just so proud to have once again received an award for this that Steve's going to tell us about.
The Corporate Excellence Awards are given in Singapore by an organization that's comprised of the Singapore Chartered Accountants, the Singapore Institute of Directors, and the Business Times. You may recall that a couple of years ago, we were recognized as having outstanding governance by the Corporate Excellence Awards. And this year we've been awarded, again, recognition for excellence and what they called the Resilience Award, which really relates in large part to the company's reaction to and dealing with and handling of the COVID-19 pandemic. One of the things that the committee that gave us the award cited in particular in terms of our handling of it was our communications, both internally with our staff, with our portfolio companies, but also our communications with our shareholders and our stakeholders. And as always, it's important for us to maintain that communication, to keep an open channel. As many of you know, when you approach us with questions, we do answer. We try to be as transparent as possible. We're quite proud of our accomplishments. We're less happy with the performance of the share, although in the last year or so, as Todd noted, the share price has gone up. And we think that sticking to the business, focusing on the business, providing good communications and building the portfolio companies will ultimately lead to the outcomes that we all want. And looking at the outcomes and turning to the last slide, we're in a great place today. Not only do we have 62 portfolio companies, but importantly, a large portion of that portfolio today is more mature than ever before. 20 advanced stage companies, as noted, many new companies that have FDA clearance that are selling in the United States, that are moving forward. Large raises for 5 companies this year, more than $4 million. In fact, in 2020, we announced that it was a record year for us with 2 companies raising more than $4 million. This year, we've had 5 companies raise more than $4 million. And I think that next year, again, we will see many companies do large, successful raises. It highlights the fact that the companies are more advanced, more mature, and getting closer to success. We've had 10 exits to date. The return on those exits has been almost 10 times our investment amount with great IRR. And we're looking forward to a great 2022. And we'll be happy now to answer questions.
Okay, thank you very much, Todd, Steve, and Chaim. We've already, as I mentioned in the beginning, received a few questions which we'll answer shortly. And I see that there are a number of questions also in the Q&A box. If we don't get to your question because of time this morning, you are always welcome to shoot us an email with the question, as you do often, and we will answer them accordingly. So I'm going to stop sharing my screen and read off some of the questions to be answered. Question 1, the signing for the sale of OrthoSpin was announced. When is this expected to be completed? Todd, would you like to?
Thank you, Shara. No, I'm pleased to let everyone know that it's all done. We have the lion's share of the cash received and in the bank. The transaction's closed. The company's in the hands of Johnson & Johnson.
Okay, an announcement on the completion will be published in the next day or two. You can look out for that. The next question, would shareholders be provided a dividend due to the sale of this company?
Thanks. It's a really important question. We announced our dividend policy earlier this year, and the dividend policy does talk about paying a dividend as a percentage of an exit, subject to having certain cash balances at the end of the year. So we will evaluate the issue at the end of the year. Based on the end of the year cash balance, as well as the exit amount, we will make an announcement, I imagine, after our year-end board meeting around the end of February, beginning of March, as to what, if and how much of a dividend we'll be paying.
Okay, now next question. What other efforts is management undertaking to increase the market cap of the company?
You know, we can't make efforts to increase the market cap of the company per se. We're not focused on the share price in the sense that we're looking to manipulate it or to encourage trading in it. We do talk about our successes. We do have an active IR program. In fact, we were recognized for our IR program in the past as well, to talk about what we're doing. But the thing we can do best to impact the market cap, I think, is to perform. We had an exit last year. We had an exit this year. We have a dividend policy, which I hope and believe will lead to our paying dividends in the future. And I think as that we continue to have exits, as we continue to see the portfolio value increase, and as we continue to perform, I believe that the market cap will adjust appropriately.
Okay, next question. Is a dual listing on a different exchange still being considered?
We made an announcement relative to this, that we discontinued our discussions relative to joining the Tel Aviv Stock Exchange. That is our current situation at this time. Thank you. Okay,
the next question is regarding the amount due to us from the OrthoSpin exit. And I think it was answered in the presentation as well, but I see that there are other questions that pertain to this. So I think let's have a quick run over on the IRR of the OrthoSpin exit is 165%, and our consideration was 15.8 million. If the company was sold at 79.5 million, how do the numbers figure out what was our investment in the company? These are all questions that people doing the math are not getting to the answers, and so maybe let's explain it.
Okay. Sure. I touched on that just a bit in my comments earlier. The fact is that the company, out of the proceeds, had to pay taxes on the sale of its assets. That is the principal reason. There are other factors as well as payments to the Israeli government, but those key factors lead to a net number. And from that net number, we received our percentage of the proceeds from the exit.
To complete Todd's answer, we do invest, as the question was applied to, we do invest only dozens of thousands of dollars we invested dozens of thousands of dollars in OrthoSpin in its early years. But we did also had a larger investment of around $1 million a year before the exit. So the IRR most impacted by the small investment we had in the beginning, in the early years of the company, but our ability to keep a big chunk and holding more than 26% at OrthoSpin at exit date, partially as a result of our larger investment in a year before the exit.
Okay, another question that I see that's also kind of repeat. All of the exits since Trendlines listing have been from the medical industry. Would it be fair to say that the ag-tech industry is in an earlier stage of development compared to medtech? And another question that related to that in the questions was, should we be focusing more on medtech, seeing as they seem to bring us more returns than ag-tech? What are our thoughts on this? Steve, please take the question.
It's a really interesting question. And it's true that all of our exits to date have been from the medical portfolio. We have to remember that the medical portfolio is older than the agri-food portfolio. We began investing in medical device technologies back in 2007 when we established the Trendlines group. And we only began investing in agri-food technologies some 5 years later. So our agri-food portfolio is younger. I think there's also an industry difference between agri-food and medical, and that is that in the medical industry, there's more openness to early exits. We still need to show success in the clinic and some early sales in many cases, but I think there's more of an openness to early exits. And the agri-food side, we've seen tremendous value created. I noted some of the companies that have raised large amounts of money, and many of them come from the agri-food space. AgroScout, MetaMotion, Fidalon, and others. These companies are contributing a lot to our NAV, to our portfolio value, and I think in the future we'll see very significant exits. They may, I don't think they'll on average take longer than the medical exits, but I think that they're just younger companies. So I think we just have to be a little bit patient there.
Okay, another question that's an interesting one related to the share price, and Trendline share price is depressed mainly because the retail investor finds it hard to know how to value the company. And secondly, the company does not have consistent earnings every year, and the predictability is difficult to understand. Can the company try to make the revenue and net profit more predictable and consistent by a structure or spin-off company with future earnings for at least 5 years, and try to aim for a yearly dividend? Please comment.
A quick point there.
I'll take the first part of the revenue prediction. As you probably remember, most of our revenue is derived from the changes in fair value of the portfolio companies. We're evaluating our companies at least once a year, and the fluctuation in their fair value is impacting the revenue and the bottom line. So it's a bit hard. It's not like a sale of a product or a device that can predict the revenue and, of course, the bottom line. So it is fluctuated, and unfortunately or gladly, it will continue to fluctuate in the future. Hopefully, all will be on the positive side.
It's certainly, we recognize that it's difficult for the retail investor to value the company. And that's one of the reasons that we try to share as much information as we do about the individual portfolio companies. If you look at the individual companies, you can see that many of them probably could be worth more ultimately than Trendlines itself. And we think that that will ultimately be reflected in our earnings and in our dividends and in our NAV. It's a work in process. I think it will always be difficult for the retail investor to totally get a handle on the value of the asset, simply because there's so many moving parts, there's so many components to it. But I think that as we go forward, as we move into a stage where we have more and more exits and more significant raises for our portfolio companies, I hope that we will be able to increase the level of confidence that the retail investor has in the Trendline story. And as that confidence increases, I hope that the share price will follow.
I just want to encourage all of our shareholders and those looking at us to sign up for our monthly trend letter, which highlights the activities of some of our portfolio companies, and as well to sign up for our announcements to the market. These are two good sources of information about us. As Steve commented earlier, that we make ourselves available. We're happy to speak to people about what we're doing. The website is a wealth of information about us and about our portfolio companies.
Okay, there've been a number of questions here about particular companies considering their valuations and what Trendline's stake is in the specific companies. Mentioned here are a number of the companies that we spoke about: Fitelon, Vensica, etc. Steve, can you explain why we don't disclose company valuations and sometimes our stake in the company as well? Why it's more complicated than it seems on the surface?
Actually, we do disclose our share in individual companies. That's disclosed in our annual report, and we can talk about that as much freely. The issue about valuations is more complicated because remember that these companies are out raising capital, they're out negotiating exits, and we're always concerned that if we talk about valuations, that those valuation talks and making that information public could damage the companies when they're negotiating to raise new capital at a higher rate. I'll just give an example. One of the companies we spoke about today is in the process of working on a $10 million raise, and they're looking to raise that money at a much higher valuation than the previous round, probably about 4 times greater than the valuation in their last round. We don't know if they'll succeed or not, but certainly if the potential investors knew that we were talking about a valuation 4 times greater than the last round, I think that would have a deleterious effect on the pricing of the new round. And so we're very reluctant, and up to date, we have not announced the individual valuations.
If I may add to that, when we are doing the fair value or the evaluation of our portfolio companies, those are valuations that need to follow the accounting rules, the IFRS rules, which in some cases, and I may say that in most of the cases, are lower than the raises, the value of the raises of those companies shortly after. And if the value of the valuation will be disclosed, of course, that will damage the abilities of the companies to raise in much higher valuations.
Okay, we've received 2 questions regarding schematics. Where are we on schematics? Are these assumptions that were in the past still valid?
We continue to be in contact with B. Brown and talk to them about their activities. And we look forward to them finding their way in the market on the product.
Okay. Another question on the share. Would the company consider share buybacks to take advantage of the deep discount to the NAV and improve the liquidity of the shares? In the same light, would the company also consider share consolidation to reduce the bid or offer spreads and hence trading costs?
When we look at share buybacks, we really can look at them in the same light that we look at dividends. And we've had the discussion before, would we be better off doing a share buyback or a dividend? And the decision has always come down to prefer the dividend route distributing rather than the share buyback route. Up till now, that's been our policy, and it's something that we discuss periodically, but for now, I think our focus is on dividends to our shareholders and not buybacks. As for consolidation, we haven't spoken about it recently. I'm not sure. It's certainly something we could look into, although I'm not sure it would really make much of a difference. Be happy to get information about it, and if shareholders have specific thoughts about it, to hear from them, their comments.
Okay, it's been repeatedly mentioned that there are about 20 companies in advanced stages. What sort of exits are likely from these companies in the coming year, 2022 or 2023? And will there be more than just a sporadic loan exit since the listing, as we've seen?
Well, I'll start that off. Excuse me. If we take a look at the last two exits, the one just a few weeks ago, which was $79.5 million, was the gross exit value, and then we go back to last year and we look at our sale of Epifix, that was at $79 million plus an earnout that the acquirer currently carries on its books at over $40 million. So that's a total of about $120 million on that exit potentially. As we look forward, Steve's commented, and I've also commented, that we have a maturing portfolio. While we continue to add to the portfolio by creating new companies and investing in others, we see maturation in the portfolio that's leading to more exits, we believe. We are not capable of timing these things. And that, of course, leads back to another question that was asked earlier about smoothing our profitability. Unfortunately, we will always be a bumpy road in terms of profitability. It is increases in valuation, as Chaim referred to earlier, and it is exits, which give us a big bump. And those things are under the control, so to speak, of external investors and acquirers. We can and do make plans as to when we think appropriate times are to exit. But of course, that's only done with interested buyers.
Okay, there's another question that relates, or two questions that are connected. What can we say about the new pipeline of companies to invest in? Are we seeing good companies that we'd like to invest in? And what is the split between medtech and agtech? Do we have any decisions or policies on that?
Each year we set a budget. Sorry, Steve, I'll just start it off. Each year we set a budget, of course, for the whole company, in which we take a look at the new companies we anticipate creating. That's where it starts. But we become increasingly focused on not investing in a fixed number of companies, but rather investing in companies that we think can grow quickly and bring substantial value to Trendlines and our shareholders. We have full-time deal flow people in Singapore and in Israel, and their focus is bringing us what we can truly determine to be the best of the best. Our deal flow is strong. Yet we always reach out. We have invested in companies with entrepreneurs in the U.S. and, of course, with inventors in Singapore as well. And increasingly, we invest with corporations as we have with others. Steve?
Okay. I think we're going to have to cut the questions at the moment because we're coming to the end, and both Steve and Todd have a meeting in another couple of minutes. So I'd like to just let Steve finish off the presentation for today. And as we mentioned before, any of the questions that weren't answered, you're welcome to send me a mail to shira@trendlines.com. Or to info@trendlines.com, and we will endeavor to answer your questions if they were not answered as fully as possible. Thank you.
Thanks, Shira. There was a question earlier about what we're doing to increase the market cap. And although I said that we don't actively look to how we can increase the market cap, I think that we do actively speak to the market and talk to the market. And I wanted to note that of all the quarterly calls that we've done, we've been doing quarterly calls now for many years since the listing itself. We have more participants on this call than we've ever had before. And we've also received more questions from our shareholders in this call than we've ever received before. And I wanted to say thank you to everyone who's on the call and who submitted questions, and also to encourage you not to wait from quarter to quarter but to be in touch with us as the questions come up. We try to be responsive. And I think that looking forward, the level of interest in what we're doing may also reflect a change in attitude towards the company. I was in the US on an IR trip in the last 2 weeks, meeting with the potential investors and seeing increased interest from the United States in Trendlines. I think that we're looking at an exciting period coming up that as the portfolio matures. There were good questions about exits in the future, and we certainly believe that they're in the pipeline coming forward. So I think we're in an exciting place, a good place. I want to thank everyone for joining us today. Thank you for your support, and we look forward to a great 2022 and to the period beyond.
Okay, thank you. Thank you, everyone.
Thank you very much.
Thanks very much.
Thank you.
Bye-bye.
Bye.